I am Max Kaiser. This is the Kaiser Report. Someplace special, someplace new, someplace exciting. Where are we, Stacey?
We are in Dublin at MoneyConf, and I think that's enough advertisement for them. So I'm going to ask you to put that right over that MoneyConf.
All righty, this is exciting.
This is homemade stuff here.
Oh, look at that.
We're very talented on the Kaiser Report.
Look at that.
I'm going to call it the Kaiser Conf.
Kaiser Conf. That's fine. Mine says Kaiser Oomph. It's got more oomph.
Because this is all about money, I've chosen some headlines with money as the topic for this first episode from MoneyConf.
That's great.
Yes. You know, while we've been here, not only have there been summits in Singapore, but there was also that G7 meeting in Canada where Justin Trudeau's eyebrow...
His eyebrow fell right off Justin Trudeau. Just like it was the fellow in America, Ron Paul. His merkin, his eyebrow merkin fell right off.
Yes, but over in Switzerland as well, they had one of their referendums. You know how if you get 100,000 people to sign a document, you could have a referendum on anything? Well, they had a referendum called the Volgeld. So the tweet from Wall Street Journal reads, Swiss voters rejected the Volgeld initiative, which would have put the Swiss National Bank in charge of all money creation, upending the banking system. So it would have ended basically fractional reserve banking. It was something like 70% voted against this, so it did not succeed at all, but we're going to talk a little bit more about this.
Well, it's interesting that they would even consider this, that they understand that the central bank in Switzerland is acting as malevolent, undercutting.
The commercial banks, that they said the commercial banks should not be able to print money. By issuing loans, they create money. So they wanted to take that power away from them, that commercial banks like JP Morgan, Deutsche Bank, Goldman Sachs, that they could not create money. They could only lend against their reserves, 100% reserves. That only the Central Bank of Switzerland was going to be allowed to print money. Just like in the case of America, it would be the U.S. Federal Reserve would be allowed to create money, or the Treasury.
The Treasury.
Yeah.
No, exactly. So, but they voted it down. But they're aware of it. They're aware of the effects of fractional reserve, and that money is created by loaning it into existence. That there's no collateral. Banks have no reserves against loans. They loan not more than 100% of reserves, 300% of reserves. In the case of Deutsche Bank, they've loaned an infinite amount against non-existent reserves. There's nothing in Deutsche Bank except maybe some old gum wrappers. There's nothing there to collateralize this 190 trillion Ponzi scheme of derivatives at Deutsche Bank. That's why it's going to go out of business.
But nevertheless, I want to turn to this other article, and it's Martin Wolf, one of the chief opinion makers at the Financial Times, wrote an opinion piece, saying that the Swiss should have backed this, that they should take the power to create money away from commercial banks, because commercial banks have proven themselves to be not good at doing what they're supposed to do. Now, I'm only going to read an opinion piece about Martin Wolf's opinion piece because the Financial Times is behind a paywall, and I guess they want to make money off of the Financial Times. I don't want to give them the money, so I'm going to read this headline here. Martin Wolf says Swiss should vote for Volgeld. Switzerland is toying with the idea of removing the ability of banks to increase money supply in a vote on sovereign money, or Volgeld. The question will be put to a referendum on June 10th, and as I said, they voted against it, Max. But Martin Wolf at the FT is out with an endorsement today on curious terms, saying that finance needs to change and experiments. He says banks have lost the right to be arbiters of money. Quote, the advantage of the Volgeld proposal is that it is a credible experiment in the direction of separating the safety rightly demanded of money from the risk-bearing expected of private banks. With money unambiguously safe, it would be far easier to let risk-taking institutions bear the full consequences of their failure.
Right. Well, in America, there was the Glass-Steagall Act that came in after the crash of 1929 and resulting in the Depression, and the Securities Act of 33 and 34 were introduced, and Glass-Steagall was introduced to separate banks' activity as guardians of people's wealth.
Yes,
and
as deposits.
their deposits
from their speculative behavior
from merchant banking and from their speculative behavior. So they had to separate these two. But then that was all under Clinton, Bill Clinton. You know, he got rid of Glass-Steagall. And the banks have gone back into this framework of using your deposits as their risk capital. And whenever they make a bad loan, they get bailed out by the state. So we saw this in the savings and loan crisis. We saw this in the subprime crisis. It's just banks gaming the system, gaming. Now, Martin Wolf, he's an establishment player. So it's interesting that he would make the suggestion that the Swiss banking system should embrace this, a non-fractional reserve, a wholly backed reserve banking. I mean, if you apply that to the banks in the UK, Lloyds, HSBC, Barclays, and Royal Bank of Scotland.
RBS,
right, they would all have to technically declare insolvency because they have no assets.
Yeah, I mean, you've actually been on stage here in Ireland with Martin Wolf, and he wasn't this radical back then, but he's also suggesting that citizens should be allowed to put their own deposits at the central bank, just like banks can, and that's how they're able to just spin money, because they're able to borrow from the central bank at 0% and then lend to you at like 10, 15%.
Martin Wolf, why is he making this convergence? Why is he coming to Damascus? Why is he coming to the Holy Land?
Well, if you're at the financial...
I'll tell you, because he's being pressured by Bitcoin.
Yes,
he understands the nature of Bitcoin.
Well, we're going to get to that in a second, but I want to finish up on this Martin Wolf story, because the fact is, when banks are lending money and creating money, in the UK, I know for a fact that 85% of all their loans are against mortgages, against properties. So think about the destabilization in our Western economies in America, San Francisco, Los Angeles, New York, all the homeless problem, Portland, Seattle. It's all it's on property bubbles backed by these banks lending money against that. And of course, they generate more and more and more and more profit for themselves, because they could basically created a Ponzi scheme against which they're guaranteed to make money, but it's causing destabilization across, you know, all these cities in America and Europe.
Right. The property is used as collateral, and they lend against property. And what happens? Prices are artificially pumped up and jacked up, and so people can't afford housing. So the way to fix the housing problem in the UK is to take away this fractional reserve banking against property, so that prices would come down to the level that is traditionally affordable by the average person in Britain.
Exactly. If they were lending and actually creating an economy, helping everybody, that's what they originally were meant to do, is lend to perhaps risky companies, new startups or companies or businesses to grow the economy. That would be one thing. But the fact is, they're just lending it all to a completely speculative venture, which is property, and yet it's causing the economy to worsen, because they're also locking people out from, you know, being able to move to new cities for new jobs, because property is so expensive. But they're not lending to companies. They're not lending to small businesses. Right. In fact, RBS has done the opposite. They smashed and grabbed assets using their ability to create money, issue these loans.
That's why the UK economy is so vulnerable. It's a bit of a monoculture. There's only property speculation. I know from starting companies in the UK, my employees were only interested in speculating in the property market. The idea of having a startup where the stock price goes up and you create a technology company was completely alien to them.
Well, you mentioned Bitcoin, and Bitcoin was a big topic here at MoneyConf. Of course, we've been speaking here for quite a few years, and now they're introducing CryptoConf. All of these events that have talk about money and banking, they're all having to introduce, they're being forced by Bitcoin to recognize them and start talking about it and what is this. So MoneyConf has a CryptoConf here, and this is here. But this was an interesting story as well in the headlines while we've been here, and this is from the CEO of Lazard. And if you don't know who Lazard are, they're probably the most powerful bank in the world behind the scenes. They are not like, you're not going to go, it's not a high street bank, you're not going to go deposit your funds there, but they are very, very powerful in terms of how they can control the total banking system, the Bank of International Settlements and governments. So here is the CEO of Lazard Bank, and he says, you can imagine crypto replacing the US dollar. Quote, US isolationism could undermine the dollar's status as the world's reserve currency, Lazard Chief Executive Officer Ken Jacobs said. To the extent that we have unilateral foreign policy and unilateral trade policy were sort of tempting the world to find an alternative, he said in a Bloomberg television interview. Probably the greatest demonstration of soft power is the fact that the U.S. has the reserve currency of the world. So he says Bitcoin could replace the U.S. dollar.
Well, we're right on track from what we predicted on this show 5 years ago, that at some point the various nation states would have to give up and realize that their fiat money currency systems from central banks don't work. Even Martin Wolf, who's one of the most blue-blooded establishment hacks of the Financial Times, is now essentially espousing Bitcoin and full reserve banking over fractional reserve skullduggery and property market Ponzi schemes in the UK. That's quite a turnaround.
Yeah, but the fact that Lazard Bank is also saying this, and they're the most establishment bank, French bank, and
well, Lazard Frere, you know, Felix Rohatyn, which was their CEO back in the 70s and 80s, they orchestrated the Municipal Assistance Corporation, or MAC, bond turnaround for New York City. They're the go-to advisors for the insiders of these various nation states, and they have a great reputation. And they see the writing on the wall. They realize that Bitcoin is about to kill all fiat currencies, deader than a bag of hammers.
But you and I have also said here on Kaiser Report, you heard this here first, we did say on Kaiser Report years ago that when the U.S. started using unilateral power, the fact that we're in a unipolar world led by the U.S. as an empire, they do have a lot of power, but they don't, because as soon as they use their unilateral power, alternatives spring up. When they start imposing restrictions on people accessing the global financial system through SWIFT, for example, we said Bitcoin's going to be used as an alternative, or gold or something like that. So this is what we're seeing with statements like this coming from Lazard Bank. It's not like it's coming from RBS, which has no power on the world stage. Lazard does.
There's two mutually exclusive pieces to the puzzle. If you make America great again, you lose U.S. dollar as world reserve currency. Those two are mutually exclusive.
Well, notice he didn't say that the euro would replace it. He says Bitcoin. Nobody wants. It would be maybe good to have a neutral platform like Bitcoin, which nobody can
duh. I mean, it's not going to be the special drawing rights from the IMF.
That's
Jim
Rickards.
Jim Rickards. You know, he's wrong. It's going to be Bitcoin. Hey, we got to take a break here at Kaiser Report coming to you, a special report. Don't go away. There's plenty more coming your way. I think we're going to talk to Tone Vays. That's right. Stay there. Welcome back to the Kaiser Report. I'm Max Kaiser. I'm here with Tone Vays. Tone, welcome back.
Hey, Max. Thanks for having me back.
You know, I just want to make one quick comment. I am wearing the exact same outfit, including this leg, that I wore at Charlie Schramm and Courtney's wedding.
Oh, wow.
Okay? I was in my closet looking for something to bring to MoneyConf, and I hadn't worn this since then. I thought, why not wear the Schramm wedding outfit? You know what I'm saying?
Yeah, no, very good choice. I had to dress up to just get off stage here at Money Conference.
You're looking sharp.
Thank you.
Speaking of MoneyConf, it's a bit, let me get your reaction to this. It seems a bit corporate, if you know what I mean. So first of all, it's not crypto, it's money. And it's like there's a lot of corporate vibe here. It's different than the usual crypto conferences that we go to, Tone.
That's true. And actually, like, it feels like half the people I speak to are in the KYC business.
Right, know your customer, which is a huge trend now in crypto. And especially for ICOs that were launched last year, they're now being revisited, and they're being asked to provide KYC, know your customer, rules and regulations. The regulators are coming into the space in a big way, Tone. Is that a surprise? What do you think?
It's not a surprise at all to me. I've always saw all of these ICOs going back to Ethereum's ICO as securities. And it was kind of good that Jay Clayton finally made it somewhat clear in a recent interview when he said, if your token was created by an enterprise, which almost all of these are, and if anyone is buying this token with an expectation of profit, then you're in violation of the Howey test and you are a security. And if you are an ICO in the space, you should probably be a little bit nervous right now.
Yeah, Jay Clayton, he made an interesting statement where he's basically conflating IPO with ICO. He's saying if you're interested in doing an ICO as a private placement, do a private placement. But if you're interested in doing an ICO or an IPO that's outside of a private placement, come see us at the SEC. So there's not even a cigarette paper between IPO an ICO. The industry expectations, if you talk to the crypto people, were that we're reinventing IPOs. The rules don't apply to us. It doesn't seem to work.
Right now, I will say, however, it's a little bit disingenuous in that a lot of them tried to go to the SEC a while ago, and the SEC kind of wanted nothing to do with it. So they are late, and unfortunately, they are a big arm of the U.S. government, and even though that they are late, they can still get you. They're still going to say it was your fault.
Yeah, Bernie Madoff was in an open investigation for more than 10 years, I think, and they went before the regulators 3 times with proof. You know, that's all they do all day is look at stuff. Now, you were on stage here at MoneyConf with Stacey Herbert talking about crypto and its securities and investing, and the point came up about Reg D investment. And I think the debate, if I can characterize it correctly, was that, well, you know, Reg D precludes anyone from having a certain net worth or income from participating in, let's say, a Reg D offering. And a lot of people on the other side of the debate are saying, hey, wait a minute, that means like most of the market won't be able to participate. What are your thoughts?
Yeah, so that was actually a really good question, and that comes up a lot. This idea that, well, how come only rich people get to invest in Facebook's pre-IPO shares, right? How come something like that isn't opened to the average investor? And my argument to that has always been, well, it's a very speculative investment, and even professionals can't get it right. 90% of all businesses fail, especially businesses in brand new technology. The failure rate's probably even higher, but people still feel that the little guy should have a chance. And it's a tough argument. And now I kind of say, if you really want a high risk investment, just go invest in the stock market. At least those companies have already proven they're past the pre-IPO stage, and they're already publicly traded. And most people feel that the stock market is always overpriced and always too dangerous and always too risky, without realizing that all of those companies that are currently in the stock market were 100 times riskier before they made it into the S&P 500. But for some reason, people think that that's not risky. But S&P 500 companies are companies with revenue, companies that have a very low chance of going bust.
Right, this argument that, well, how come I didn't get a chance to buy Facebook? It's a bad argument because along with Facebook were 100 other companies trying to do something similar, and 99 you never heard of, or they all went bust. So to say that, oh, you were able to pick that one that was Facebook is fallacious. Plus, even venture capitalists, their hit ratio is 1 in 10. They're 90% losers.
And they're the experts.
And they're the complete experts.
And to the Facebook thing, I say, well, all of your money would have probably been in MySpace, because that's where my money would have been. I always thought MySpace was better, and I was a user of MySpace. I hated switching to Facebook. I just had no choice. And you're right on that. And my best example of this is the biggest pre-IPO investor in Pets.com was Amazon. So even they didn't know.
Right.
But they were going to win.
Right. The regulations are there. And look at the pension market, for example. You know, we went through a transition in the 80s where pensions were being self-directed by employees and taken out of the hands of corporations. And individuals ran them into the ground. In 2008, they got wiped out, right? Because individuals couldn't handle the volatility. So they were, before then, just getting a coupon clipping 4 or 5% return every single year. They retired with something that was, you know, a nice pot of money. But if you give the individual that choice, they get caught up in the emotions. They're not professionals. They get wiped out. So I'm making the argument that Reg D serves a purpose. So let's visit the other side of the argument for a second. In the space of crypto, it is part of, is there a way to get more public participation in crypto in a way that satisfies both the need to protect people from getting wiped out and still have exposure to these emerging technologies?
Well, Bitcoin, in my opinion, is your safest bet. But once again, just like people don't want to invest in the S&P 500, and they would rather invest in Facebook's future competitor as a pre-IPO, for the same reason, people don't want to invest in Bitcoin, and they want to invest in these competitors that have a very low probability of success. They're basically buying up lottery tickets, and we all know that's not a very profitable way to make a living, going to buy lottery tickets, but that's what you're doing in crypto. If you want a safe investment in crypto, go buy Bitcoin. Don't put all of your money in Bitcoin. If you want to do it in a tax-deferred way, I hate saying it, but GBTC is your only option. You can buy that in your retirement fund. And you're right, I self-direct my own 401k. I'm responsible for my own retirement money. And you can do that. You can go buy GBTC. Hopefully there'll be a better ETF on the market soon, better than GBTC. And then you can buy it as a tax-deferred retirement account and diversify your portfolio a little bit.
Right, let's talk about Bitcoin for a second. So you follow technical analysis, and you're known as somebody who teaches groups how to do technical analysis. And technical analysis is really the other side of the analysis portfolio one on Wall Street uses, the other being fundamental analysis, where you're looking at the actual earnings of a specific company and determining their growth rate. Technical analysis, you're just looking at the price charts and you're making certain assumptions about how prices tend to repeat and patterns repeat because they're subject to human emotions, and human emotions never change.
Exactly.
So people get greedy at the top, they get bearish on the bottom. When I was working on Wall Street, you have many what are called contrarian indicators. People tend to buy puts at the bottom. So the put-call ratio is bullish because it's a contrarian indicator.
Yeah.
Now, these are all very useful tools, and crypto space is a very young space. It tends to be technological. I was resisting saying geeks and nerds and dweebs, but I mean, that's what we're talking about. This is all very new to them. How has that message been accepted?
That's actually been great for me because I recognized pretty early when I started writing in the space about price and technical analysis that I really am dealing with a lot of people that are getting into trading because of this the removal of barrier to entry to become a trader and a speculator on all of these assets without any kind of learning. It's almost like, hey, you know what? Let me go drive in the Indy 500 before I got my permit and drive in a car. And I kind of carved out this little niche where I have experience in trading. I have watched the markets for 15 years. I've worked on Wall Street for 10 years, lots of trading experience. And hey, let me at least educate people on how to be traders. It doesn't mean they're going to make money trading, but at least they'll have an idea of the other side of trading, which is technical analysis and using charts and using those emotions and putting yourself in better probabilistic bets to potentially profit from the market. The problem that we have is people can't separate, because they're too young of investors, they can't separate the idea of an investor from a trader. A trader should never be married to the asset that they're trading. It's just something. So if you are in love with Bitcoin or you're in love with Ethereum, you're not going to be a very good trader of those assets because you're emotionally involved. The best traders are never emotionally involved with the assets that they're trading. And
right, there's two sides to this. One is making money. The other one is risk management. So technical analysis can be a tool for speculation, but it's also a tool for risk management, as far as where to put in stops and other orders to keep your money from being drawn down. I mean, this is what the trader, once you draw down money, you have the arithmetics of losing. It takes more money to get even than the amount of money that you drew down. So if you drew down 10%, you got to make more than 10% to get back to even. So this is the cycle that people get into, and it's very destructive. And I want to talk about something, a 51% attack. When Satoshi Nakamoto envisioned Bitcoin, he talked about the 51% attack. And we know that it's been resistant to a 51% attack. He did not mention futures in the white paper, or any of the correspondence he had with anyone that I'm aware of did he mention financial futures. We do now have Bitcoin futures. And the argument against the 51% attack put forward by Satoshi is that, according to game theory, you wouldn't do it because you'd wipe yourself out. But if you took a position in the futures market and then you attacked Bitcoin, say you took bought a put on Bitcoin, and then you killed it with a 51% attack, there's some room to manipulate or to make markets or to trade. Your thoughts?
I think that would be very, very difficult because the futures have just come online and the volume on those futures is pretty low. The leverage on those futures is also pretty low. But the Bitcoin hash rate and the ability to get that 51% is very, very high. And by the time futures could be liquid enough to profit well from this kind of idea, the hash rate is going to be exponentially higher still, making it so hard to do the 51%.
So it gets back to Bitcoin is running ahead of the devil.
Yeah.
It has since day one step
Correct.
ahead of the devil.
In addition, it would be a very dangerous bet because as the Bitcoin market grows higher, who's going to be the counterparty? Yeah, you're going to take on all of these short plays. Like, remember what happened in the financial crisis, right? Everyone thought they were going to make so much money off of the proper position on the CDOs, except the counterparties also failed.
No liquidity.
Right, no liquidity, right?
Right.
So just because you made this giant bet, and you were absolutely right, what happens when your counterparty was too leveraged and the counterparty goes down?
Well, there's an old saying called you have to feed the ducks when they're quacking.
Right.
Have you heard this one?
Yes. And the intermediary, the CME, has insurance to back this up, but they could also not have enough. This is what the CEO of Interactive Brokers was very, very worried about. But on the upside,
Right.
not on the downside, that there may not be enough backup and liquidity to do it. So it's difficult. And I always say, a lot of people, there are gold bugs, a lot of people that want this catastrophe to come, but you don't realize if the catastrophe is too big, nobody wins.
John Vase, thanks for being on the Kaiser Report.
Thank you.
That's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, John Vase. If you want to catch us on Twitter, it's Kaiser Report. Until next time, bye, y'all.